Hi, I'm Justin Williamson, Certified Financial Planner and Senior Partner at Center for Wealth Management. Today we wanted to talk to you guys about the One Big Beautiful Bill Act and some of the more important tax issues that we expect will impact our clients in 2025. And so this is not an exhaustive list, but again, some of the highlights of what we've seen so far. First of all, we've got the state and local tax deduction. This is for your property taxes, your state income taxes, if you're in a state that has that income tax. Over the past several years, since the Tax Cuts and Jobs Act of 2017, that deduction, if you itemize, has been limited to $10,000 a year. With the passage of the OBBBA, the deduction limit has now gone up to $40,000. So quite an increase there. Hopefully we'll save a lot of our clients some money with that additional deduction amount. It does phase out though for single taxpayers at $250,000 or for joint filers at $500,000. That deduction limit will start to phase back out. Once you hit $600,000 for joint filers, it'll go back to the original $10,000. So an interesting change there. Also some changes to overtime income. With overtime, obviously generally paid 1.5 times your hourly rate. What you're able to deduct here is that half. So if, for example, I have 10 hours paid at 1.5 times my normal, I can take 10 hours at the half rate as my deduction. But that total amount allowed is $12,500 for a single filer, or again, $25,000 for a joint return. So child tax credit is also one that's changing a bit. So previously it's been $2,000 per year. It's been a static amount for the last several years. That is going up to $2,200 per qualifying child. Generally means that you're providing more than 50% of the support and that they are under the age of 17. So that new amount is going to be $2,200 for this year and will be indexed for inflation moving forward. There's also something called an other dependent credit, where a lot of times your children that are over 17 would fall into this particular category, but it doesn't have to be a child. It could be any dependent that you're providing, again, more than 50% of their support to. That credit amount is going to be $500 now. We've got something new called the senior bonus deduction. So there's a lot of talk about whether Social Security would continue to be taxable. The answer is that it is going to continue to be taxed just as it has in the past. What they've done though is provided this additional, what they call senior bonus deduction, which is $6,000 per qualifying taxpayer. So if you're a joint return and you both are eligible for this, which is age 65 or older, it's $6,000 a year, so $12,000 for a joint return. And this can be used against any income. It doesn't have to be used just for Social Security. So if you're 66 and not collecting Social Security yet, you can still use this bonus deduction on your return. Something new also is the auto loan interest deduction. So we've not been able to write off the interest for our auto loans previously. Many of us still will not be able to, but there is an exception or a new rule being allowed for a deduction of auto loan interest that is for a financed new vehicle. So it can't be a used vehicle, but a new vehicle. And that vehicle must have been final assembly in the United States. So some specific criteria to that, but a potential opportunity for some of our clients. The last one that I'll touch on today is the charity. There are new charitable deductions. So for the past several years, we've not been able, many of our clients, to itemize deductions because the standard deduction amount was increased, again, with the Tax Cuts and Jobs Act in 2017. So in order to itemize, we would have had to have, as a married couple, say more than $30,000 roughly to be able to make sense of that. With that, many of our clients who make charitable donations have not been able to write those off or get some specific tax benefit for that. Well, now you can still take the standard deduction amount on your tax return and also now get some benefit for your charitable contribution. So the first $1,000 for an individual or $2,000 for a couple filing jointly can be taken as an additional deduction beyond the standard deduction without itemizing. So that's new there. In addition to these changes, there's also a second change that's coming our way. This one will start in 2026 regarding charitable donations and the deductibility of those. But this one will apply instead not to the standard deduction of people using the standard deduction, but to those that are itemizing deductions. And the change is that you will now have to surpass at least 0.5% of your adjusted gross income before you can take that donation, meaning that first 0.5% of your AGI in terms of charitable donations will not be deductible for you. So it's a floor essentially. You have to make at least that much before you can then start to deduct those. And with that, in 2025, there are some considerations that you may wish to make. For some, you may want to accelerate your charitable donations this year in order to get a bigger bang for your buck. So those are some of the highlights so far that we've seen. We'll continue to keep an eye on that, but wanted to give you an update on what those opportunities might be for you. If you have questions about how these things apply to your situation, whether they apply to your situation, or how to take advantage of them, feel free to reach out. We'd be happy to sit down and have a consultation. Thank you.